Good morning, everyone. My name is Renee Daggett. Thank you so much for attending the AdminBooks 20% Business Deduction webinar. We're really excited that you are joining us on this webinar. We really want to lead the way in providing information about what you can do in your business to get a deduction for 2018. As I mentioned, my name is Renee. I have Misty and Sabrina on the line. We'll wave here at you. We are going to be giving our presentation of the 20% deduction. So who is AdminBooks? We are an accounting firm in California near San Jose. We do taxes, payroll, and QuickBooks Online. There's 14 of us spread throughout the U.S. And recently we earned the prestigious award from Intuit, naming us as one of the top 15 accounting firms out of the U.S., Canada, Australia, and United Kingdom. So we're honored to have that award. But today I wanted to introduce to you Sabrina Wilcox. She is on our team, and she is a CPA. I believe, Sabrina, you got your CPA license in 2009, graduated from, was it Michigan, the state of Michigan?
Correct, yes.
And got your bachelor's degree there. So we are really excited to have Sabrina teach us. She's one of our top preparers for AdminBooks. She's married to, I like to do fun facts, she's married to her high school sweetheart, and she passed the CPA exam on her first try. She's our go-to person when it comes to all of these details, and we're real excited to have her on the call today. As far as some housekeeping items, there is a control panel on your screen that will have the handouts. There is a PDF copy of all of these slides, and you can grab those and follow along, or you can save this handout for later and forward it to any of your family or friends. Please know that you are on listen only mode, and we welcome you to type in your question in the question chat box. We will be answering those questions at the end of our presentation today. Keep the questions general in nature. If you have a specific question, perhaps we can talk to you after this webinar, but do enter any clarifications that you have in that chat box. So this is our disclaimer, just basically saying that this webinar is intended for educational purposes only. Please consult your tax preparer for your specific situation. And now I'm going to pass it on over to Sabrina, and she's going to talk to us about the agenda, what you're going to learn today. Take it away, Sabrina.
Thank you so much, Renee. Hello, everyone. It's so good to be speaking with you today about this highly talked about, highly anticipated 20% business deduction. So we'll kind of look at our agenda items here. I like to keep it non-technical, so we kind of have some fun topics here. So who, what, where, who gets the deduction, what is it, where will it show up on your return? And then limitations. What's the catch, right? If it was as simple as 20% of your profit across the board, we probably wouldn't need to have this webinar. So what are those limitations? What do we need to be aware of? Show me the numbers. So again, kind of going through some examples, we actually look at some winner and loser scenarios because that kind of helps to sort of frame it maybe to your situation and see how certain circumstances affect your situation. So we'll look at some examples. We'll briefly touch on what about losses. So what if you have losses for the year in your business activity? And then we'll talk about a few takeaways, the biggest being plan, right? And before we dive in, just kind of a secondary disclaimer here. Obviously, this is can be a highly technical topic where you can really dive into some very specific, very technical calculations. And our goal today is not to so much do that because we don't want your eyes glossing over or eyes going crossed here. More so, we want to show you some examples so that you have more of a bigger picture idea of how this works and how it might impact your situation. So again, we're not doing it to get too technical with the calculations, but just to really give you a bigger picture idea. Okay, and so with that, let's dive in. Okay, so we start out with who, what, where. So first of all, who qualifies for this deduction? And keep in mind, in all of the scenarios, we're treating these as trade or business activity. So, it has to be an actual trade or business activity that you're involved in. So if you're a sole proprietor, you file Schedule C, you're entitled to this deduction. If you are in business for rental real estate and you're filing Schedule E, if it's your business or trade activity, that would qualify as well. Disregarded entities like single member LLCs, you also file a Schedule C, just like a sole proprietor. You would also qualify, again, given that if it's a trade or business activity. Multi-member LLCs and partnerships that file Form 1065. Again, if you meet that, if it's a trade or business, that would qualify. And then any entity that's taxed as an S corporation where you file Form 1120S, you also qualify. And so I'd like to point you to our little picture, our graphic over here that really just, it overall kind of tells us what we need to know. S corps qualify, partnerships qualify, sole proprietorships qualify, not C corporations. So what you can take from this is pretty much everybody but C corporations qualify for this. What is the deduction? So it's up to 20% of your qualified business income, or QBI, and you'll see QBI referenced throughout these slides. And what is QBI? It's really your business profit. It's your total income collected, your gross income, minus your business expenses. So it's that bottom net profit number. And just keep in mind, QBI does not include a few items. It does not include capital gains, dividend and interest income, so like investment income, does not include employee wages. So if you are an employee working for a company, your W-2 wages are not QBI for purposes of this deduction. Owner and partner draws do not qualify. So if you're in a partnership and you're taking draws, that's not QBI. And any money generated outside the US. So again, those are some items that do not fall under the QBI classification. And then where is it on the return? I'm a very visual person, so I like to kind of get a feel for where am I going to see this? And we have a couple of graphics here. I know they're a little bit small, but we have an initial draft copy of the Form 1040 that we had earlier in the year that does show that it actually shows up right before taxable income. So after your adjusted gross income, before your taxable income, you will see this deduction show up. And we actually have a newer graphic here. This is based on the new draft postcard 1040 that has come out, that is being reviewed right now and kind of tested out. So it's a lot more condensed form, but it's the same idea. And if you can kind of see here, this is very small, but it shows up right above taxable income. So that's where you can expect to see it. Okay, so limitations, what's the catch? So yes, there are a couple of limitations that may apply to you. The first thing that you have to think about is whether or not your business is a specified service, trade, or business. And what this basically is first of all, it's any type of business that falls within these fields here. So health, law, accounting, actuarial science, performing arts, consulting, financial services. So you know that if you fall into any of those, and I know several people probably fall into this consulting item, you are going to be considered a specified service, trade, or business, and you will have special calculations that you have to follow. The other piece of this that's a little bit still gray in our minds is that it also says any activity where the reputation or skill of one or more owners or employees is the principal asset of the business. And this is where we're getting a lot of questions about this because that's, that could really lump in a lot of different people. And I don't think the intent is for, say, for a manufacturer, for example, who manufactures widgets. There may be a lot of skill that goes into that and maybe some reputation too, but I don't think the intent is for that to be considered a specified service, trade, or business. So this is where we are really going to need, I think, more guidance from IRS, and I expect that we will get it because there will be a lot of questions. And of course, when we have court cases that come out, right, because then we have some precedent there that we can kind of follow. But again, just keep in mind, if you fall into any of these, you're definitely a specified service, trade, or business. Beyond that, you really need to, on a case-by-case basis, look and see, that reputation skill factor, does that apply or not? So if you're a specified service, trade, or business, if your taxable income is over certain thresholds, you don't get any deduction. You are just completely out of luck with this. And if we go to the next page here, I have a little graphic here that kind of just gives you big picture, an idea of how this works and the thresholds. So if you'll notice here, for a specified service, trade, or business, and we have joint filer thresholds and then other filer thresholds here. So if you are below $315,000 taxable income as a joint filer or $157,500 as another filer, you get the full deduction. there's no limitation, even though you're a specified service trader business. If you're above 415,000 joint and 207,500 or for other filers, you get nothing. So you kind of, again, straight out of luck. If you're 416,000 taxable income and you have a specified service trader business, you get nothing. And you'll see in this middle category here, you're going to get something, but it's going to be limited. And again, I think this is really important because this kind of shows where strategizing might be really important, right? Because if you're somewhere in the 325,000 and you can strategize to get yourself below that 315, you don't even have to worry about any special calculations. You just get 20% of QBI. So that's really important. Okay, and again, on this one, I don't want to overwhelm you with the calculations, so don't worry. I more just want to show kind of what I was saying before about if you're in that middle category. So again, you fall between the 315 and the 415 for joint filers. You're going to have some of your income be treated as QBI. So you're going to get something, but it's going to be limited, and it just makes the calculations more confusing, right? So here in this example, we have a scenario where there's taxable income of 345,000. So we're over that 315, but not over the 415. So a portion of the profit from this activity is going to be considered QBI, only a portion of it, right? So that, again, I won't go through that line by line, but that kind of gives you an idea. And just remember with the thought bubble here, if your taxable income is over 415,000 or 207,500 for non-joint filers, you get nothing here. So again, that's really, really important. Just kind of keep that in mind. You want to definitely get under that 415 and ideally under the 315 so you don't have any limitation. We also have what's called the wage and property limitation. And so when this limitation applies, it is your deduction, what you receive for the QBI deduction is limited to the greater of 50% of the W-2 wages that were paid by your business, or 25% of the W-2 wages paid, plus 2.5% of your qualified business property. Qualified business property, it's really any property that you depreciate, right? So if you have equipment, if you have, a building, right, that would qualify. But this limitation, kind of the same thing, it only applies at certain taxable income levels. And if we look at this next slide here, so this graph kind of gives us, again, kind of a feel for where we need to worry about this limitation. And if you'll notice, there's specified service trader business and non-specified. So we kind of break it between the two. And again, I'll point out again here that if you're a specified service business, if you are below these thresholds, you get the full 20%. If you're over those upper thresholds we talked about, you get nothing. So if you're in the middle, that's where this wage and property limitation is going to kick in. It's going to phase in. If you're a non-specified service trader business and you're above those upper thresholds, you don't lose out on the deduction, but you're going to have to apply this wage and property limit fully. If you're in the middle, it's going to be what we call phased in. So it's like a limited limitation, if that makes sense, a reduced limitation. So again, just kind of not wanting to overwhelm you with the numbers, but just give you a feel for the difference between the two types. And in this graphic, just wanted to show you here how having wages, no wages, property, no property affects the scenario here. And you can see, I won't go through all of the calculations here. I just want to show you the bigger picture. We have 3 different scenarios here, all with QBI, qualified business income of 500,000. We have the first scenario where there's no wages paid by the entity, so no employees there, but there is $1 million in qualified property. Okay, and so we can see here, if we just got the 20%, that would be 500,000 times 20% is 100,000, but we have to go through this limitation calculation because we're over the taxable income thresholds here. And so we can see, again, no wages paid. So 50% of wages is 0 because there were none paid. But we do have the $1 million in qualified property. So we get to take 2.5% of that here, right? So 25,000. So we take the greater of those two, and 25,000 is what we get out of the 100,000 that we could have gotten. In this scenario here, we don't have any property, but there are wages that were paid. And so again, we have 80,000 of wages. Again, right off the top, you could get up to 100,000 in deduction, but we have to factor in this limitation. So 50% of the wages paid, 40,000, and then 25% here of the wages paid, 20,000, because again, we don't have any property. So we get to take the greater of the two, and it's the 40,000. And then here is kind of the best case scenario in this situation where you have both. right? And again, I won't go through everything here because you kind of know where I'm going with this, but you can see here the greater of these two is the 45,000. So we get a little bit more here. We're not getting the 100,000 that we could have gotten, but we're getting 45. So at least we're getting something. So you can see where this is pretty important as to whether you're paying wages or not paying wages, whether you have that property in your business or not, really may impact this deduction. And I wanted to just briefly touch on, evaluating your entity structure. We've heard a lot of questions about, does it make sense for me to change my entity type? If I'm a Schedule C sole proprietor, should I become an S corporation? And this is a very good question. This is the year to kind of really look at that, right? We often talk about analyzing that anyway and determining if it can save you money to become an S corporation, but now maybe even more so because of this deduction. And in this example that we see here, I've given 3 different entity types: Schedule C sole proprietor, 100% S corporation owner, and then a partnership where you're 99% owner. And so again, kind of without going through these line by line, just kind of want to show you here. So the Schedule C, we're assuming in this situation, no W-2 wages paid. Okay, there's a little bit of qualifying property, not a ton, but no wages paid. And so that's kind of the big kicker with this one, is that, again, at 500,000 of QBI, you may be entitled to up to 20% of that, so 100,000, but we have to apply this limitation. And because we're not paying any wages, all we get is the 2.5% of our property, $2,500. So out of 100,000, only 2,500 deduction. I mean, ouch, that hurts. Whereas when we look at the S corporation, so again, this is kind of same numbers here. We've got 500,000 here at QBI. Here it's 375 because remember, you're paying yourself a wage now as the owner. So 125,000 of wages. Oh, that's going to help us, right? Because in this limitation calculation, we can now factor in those wages that we pay to ourselves. So 50% of the wage limitation, 62,500, and then we have the 33,750 for this number. So we get to take the greater of the two, and so we get 62,500 instead of 2,500 here. So big difference. And then again, the partnership, you can kind of see that's a little bit similar to a sole proprietor, and again, not very beneficial here. So in this case, it probably makes sense to become an S corporation, to incorporate and do that. But it might not make sense. So on the next slide, I give a different scenario. The numbers are a little bit different, but in this case, the Schedule C sole proprietor is paying wages to employees, not yourself, right? Because as a sole proprietor, you don't do that, but maybe they have other employees. And so in this particular situation, we have 150,000 in W-2 wages, so we can factor that into our limitation calculations here. So 75,000 versus 40,000, so we get to take the greater of those. So we're getting 75,000 out of a potential 90,000. So that's pretty good, right? Whereas in the S corporation situation, so I've factored in here again that as an owner, you're paying yourself some kind of wage, but you're also paying other employees. And so when we look at this, the QBI amount is actually, it's a lower number, again, because you're paying yourself a wage, so it's 325. So when you look at the 20%, that initially you could get up to 65,000. And when we look at the wage and property limitations, those are higher. So we get to take the lowest number out of all of those. And so it's 65,000, and kind of same with the partnership. So in this circumstance, maybe you should just stay a Schedule C. Maybe it doesn't help you. With that being said, this is looking only at the deduction, right? There may be other reasons why it still makes sense to become an S corporation. You have to kind of weigh the savings, the self-employment tax savings versus maximizing this deduction, finding that sweet spot. And that's, again, why strategizing is really, really important. So don't just necessarily think that, changing your entity type is the best way to go. It may not be. So it's worth a second or third look. Okay, so now we're into show me the numbers. And again, like I said, it's not my intent to have your eyes glaze over and to cause more confusion. I just want to give you a few scenarios to try to apply to your situation and to show the dynamics of these limitations and how they might affect you. But I start out with, I think, again, it's a little bit confusing with this to follow the flow of how this should work. So I included some steps here just to give you an idea of how this works and how the flow works. So the first thing you want to do, step one, is identify your QBI for each business activity you have. You may have more than one. So that's your first step. Second step, compute the initial deduction. Figure out what 20% of that QBI is. because you know right off the bat you can get up to that much. Step 3, if you're within those thresholds where you're required to look at this limitation, apply the wage and property limitation for each activity so that you can compute your tentative deduction. Step 4, you want to combine the tentative deduction for each of those activities. So you can kind of come up with one deduction amount, one net deduction amount. And then step 5, you want to limit your overall deduction to taxable income less net capital gains. So of course your deduction cannot exceed your taxable income less net capital gains. So let's look at a few of these scenarios. And again, we're looking at them from winner and loser perspectives, just so that you can kind of see, again, some of the dynamics of these limitations. So in this first example, we have a married sole proprietor with a Schedule C accounting business. So right off the bat, we see accounting and we know that's a specified service business. It's a service business. Taxable income and QBI are $200,000, just for simplicity purposes. So right off the bat, I don't even really need to do anything here, right? Because taxable income is $200,000. The threshold where we start having to factor in these limitations is $315,000. So I don't care about the limitations. We're under that number, and so we get 20% of QBI, which is $40,000. Again, not applicable, these limitations. So we get $40,000. This is winner. This is winner, winner, right? Because even though you're a service business, because your income falls under those thresholds, you don't have to worry about any limitations. So definitely a winning scenario here. In example 2, though, we have a loser. So in this case, we have a married taxpayer with an S corporation accounting business. So again, still accounting, still a specified service trader business. Taxable income is $414,000. W-2 wages are $150,000. Okay, so we look at this and, oh, there are W-2 wages paid, so that should help us, right? Well, the issue here is that this is a service business. And so this person is right under the upper threshold for not getting any deduction at all, for being completely phased out. And if you look at this, and I won't go through this again too technically because I don't want to confuse you too much, but basically because they're right under that $415,000, only 1% of their profit is considered QBI. So 1% of $300,000, which is the profit from the service business, is $3,000. So 20% of $3,000 is $600. Okay. So even when we look at the wage and property limitation, doesn't matter because all we get is that 600. That's the lower number, right? So that is a big ouch. That hurts. And that's where maybe there's some strategizing that could happen to try to get that taxable income number lower if possible. Now in example 3, we're back to a winner, yay. This is a married sole proprietor with a manufacturing business. So we're looking at this as being a non-service business for purposes of this scenario. Taxable income $450,000, QBI $250,000, and W-2 wages paid are $100,000. Okay, so in this scenario, this is a non-specified service business. So even though taxable income is $450,000, that's okay. We're not a service business, so we're not completely losing out here, but we do have to factor in that limitation. So tentatively, before any limitations, we would be able to get 20% of QBI, which is $50,000. But then we have to look at the wage and property limitation. So 50% of our wages is $50,000, and then the 25% and the 2.5% would be $33,750. So we get the greater of those. Oh, but look, we still get $50,000, right? Because $50,000 was that initial that we would be able to get, but $50,000 is what 50% of the wages are. So we still get $50,000 even after the limitation. So this is a really sweet spot scenario where even though you have that higher income and you're above that threshold, you're saved by this wage and property limitation calculation. So again, that's a winner scenario. And example 4, unfortunately, another loser scenario here. So we still have a manufacturing business, still a sole proprietor. Taxable income is $450,000, QBI is $250,000, wages are 0, and qualifying property is $100,000. And again, what I'm trying to drill home here in this scenario is the difference between paying wages and not paying wages in this scenario, because you can see, again, there's no wages here. So, you know, we kind of go through the same calculations, but then when we look at the limitation, we have nothing for the 50% of wages, and then 2,500, which is the 2.5% of our qualifying property. So all we get is 2,500 out of 50,000 potential. So again, that hurts. That's a big ouch. So there might be some strategizing there. And maybe this is a situation where becoming an S corporation and paying a wage would make sense, right? So you can get some more deduction there. And then we do have another winner here. I wanted to give one example that touched on real estate and property and how that can really help you as well. Because a lot of times when you have, if you're part of a, let's say an LLC, and you're doing, you have rental properties, or you're operating as a landlord, you're not paying yourself a wage, and so that's pretty standard. So, but your property is what could save you. So in this example, this is a winner. A married taxpayer owns commercial rental property through an LLC and actively participates as a landlord. So it is a trader business. Taxable income is $900,000. His share of QBI is $800,000, and his share of qualifying property is $10 million. Oh, that's where we're saved, right? Because there's no wages here. So again, we know based on his income, we have to go through this limitation analysis. And so we can see tentatively, we would be able to get up to $160,000 here. Then we have to apply the wage and property limitation. Without having that property amount there, we get nothing, right? Because there's no wages here. But because he has a share of $10 million property, that's $250,000. So again, we take the lesser. We can't take more than this 20% number. So we do get the $160,000, the full. So what really, really saves this guy is that building, that share of the property. So again, just wanted to kind of show you how that makes a difference, because it really is going to affect people with rental properties and so forth. And then this one, I definitely don't want to get too much into the numbers with this one, because I just wanted to show you this is where it gets really hairy. And so I said this person's kind of in the middle. They're not really a loser, but not really big time winner either. This is a married sole proprietor with an online resale business with taxable income of $375,000, QBI of $200,000, and W-2 wages of $40,000. And again, I don't want to go through all of this because this will probably make your eyes cross. It makes my eyes cross sometimes. But really what I want you to take away from this is that if you are in that, again, you're in that 315 to 415,000, so you have those limitations you have to look at, but the limitation is reduced, it's phased in. So you have to go through a special calculation here to kind of figure out what you're able to get. And again, without going through all of this, you can see that there's a limitation that applies, but it only partially applies. So instead of getting 40,000, they're getting 28,000. So it's not, you're not really losing terribly. You're getting something, but that's still a pretty good chunk that comes off. And again, that's why if you can stay out of that 315 to 415 threshold, their bracket, I would do so if you can, because that is where it gets more complex and just more work for everyone. So again, just wanted to show you that sometimes you might fall somewhere in the middle, and a lot of people probably will. Okay, so now that we're through that, just wanted to talk about losses a little bit. I think there's some confusion about that. And so what the IRS says is that for each business activity that you have, the first thing you do, like I said before, is that you separately determine the deduction that you would get for each qualified trader business. Then once you do that, you aggregate them together. So what happens if you aggregate all of your activities and you actually have a loss for the year overall? That loss will actually carry forward, and it will reduce your QBI deduction, your 20% deduction in the future year. Okay, and I wanted to just give a couple of examples, again, not to confuse, but just to kind of give a general idea, big picture of how this works. So in example one here, we can see that there are two different business activities going on. Both have losses. So right off the bat, there's no deduction this year because you had overall loss activity, and that 50,000 aggregate loss is going to carry forward and be factored in the next year when you're figuring out what deduction you should get. So again, let's say in the next year you had 100,000 of QBI and you get 20% of that, so 20,000. You're going to have to offset that by 20% of this number, right? So it's almost like this is going to carry forward and be its own activity that you have to factor in and offset against any deduction you get from other business activities. So that'll be really important. It's not like you can just throw it away, unfortunately. It will have to be factored in. And again, just a second example here, just again to kind of show a couple of different scenarios. So in this case, you do have an activity that has a profit, but you also have an activity that has a loss. And so, when we look at these, actually you have a little bit more income than you have loss, but when you come down to look at these tentative deductions, you have 5,000 from the profitable activity, but 6,000 lost from the not profitable activity. So that cancels any deduction out and you don't get it. So again, that's really important to know if you have multiple activities going on. Okay, so what are the takeaways? This is a lot that we talked about in this span of time. I think the biggest thing, and this is why I said plan, because it's really all about planning and strategizing. If you actually look at this top bullet point here, I think this is the biggest one for me, because just remember that whether you're a service business, a specified service trader business or not, if your taxable income is below $315,000 for joint filer or below $157,500 for non-joint filers, you don't care about the limitations. You can completely ignore them. You just take 20% of your profit. That's it. Easy peasy. So just remember that. Doesn't matter what type of business you are, that applies. Okay. Second bullet point, consider the entity type change. So like I talked about, this is very situational, and it's really important that you, again, sit down with your tax professional and strategize, because there are multiple things you want to look at. You don't want to just change your entity type just for the deduction necessarily, right? Because if it's costing you more in payroll tax, then maybe it doesn't make sense. And that kind of goes into my next point there about, should I convert 1099 contractors to W-2 employees? It really depends. I think a lot of people, and some of you out there may have heard of this Supreme Court ruling that came down regarding tightening up the rules regarding contractors. So I think a lot of people are going to be looking at this anyway, in terms of, do I need to change my contractors to W-2 employees? And this might be another reason to do so. Again, it's just important to remember that there are other factors to consider. And also you want to make sure that you're following the rules with that, right? You want to make sure that, it makes sense that they are employees. I mean, are you controlling their work? Are you controlling when they work? And so forth. There's a lot that goes into that. So you really want to take the time to analyze. And like I said, optimization is critical. And this is kind of what I said before. Bumping up wages might increase your QBI deduction, but it creates higher payroll taxes. So you have to weigh it. It's really important to weigh all the scenarios and figure out what's best. Run those numbers. And another side note here, I've heard this question asked a lot. So self-employment taxes are still going to be calculated on net business income before the 20% deduction. So just remember, the 20% deduction is not going to cancel out your self-employment tax. That's still going to come into play. So again, that's really important to keep in mind when you're analyzing entity structure and assessing savings and what makes sense, because you're still going to have self-employment. So again, in that comparison scenario I gave, it might make sense to say a Schedule C to get a bigger QBI deduction, but not for self-employment tax purposes. It might save you a lot to switch to an S Corp, so it might be worth it anyway. So make sure to keep that in mind. And again, planning will be key. As I said before, we're not telling you to not make money, but if you are falling, and I think a lot of folks do, fall somewhere in that gray area of the 315 to 415,000, maybe you're 320, 325, and you can strategize around getting below that threshold. And again, maybe you push some business expenses in December that you were going to pay in January. Maybe you somehow delay collection of income, something like that, to strategize around getting below those thresholds. That's going to be the most optimal. And did we already say plan? I think we did, but I'll say it again because it deserves mentioning. There's going to have to be a lot of strategizing, sitting down, going through the numbers and looking at your situation, because it really is case by case, and no case is the same as another. So that will be really, really important. And then I just have, in these last couple slides here, I just have some kind of more reference information for you. As I said, I found it very confusing when I was first looking at this. How does it flow? What am I supposed to do? Where am I supposed to go? How to navigate it. And so I really like flow charts. I think they're really helpful. So this is kind of just a reference for you to use. It kind of says, okay, takes you on different paths depending on if you're a service business or a non-service business, and then tells you, kind of, here's your deduction, or here's the limitation you need to apply. So again, just for reference, I really like flow charts. And along that same line, I have a chart here as well. I really like this because it breaks down between the service business and non-service business and gives, based on your taxable income thresholds, some examples and calculation guidance here. Again, I'm not expecting you to go through this and completely, calculate these all by yourself, but I think it's a really good reference point, and maybe you sit down and reference it with your tax professional. So again, just some information there for you to reference later. And so with that being said, I'm going to pass it over to Misty for some additional comments, and also to discuss the questions and any questions that you guys have. So
thank you so much, Sabrina. I really appreciate your presentation, and it's so helpful to have a nice overview of some of the complexities that this new tax law really provides. So with that, if you have any questions, please remember we need them to be general in nature. If you have specific questions, please don't hesitate to consult a professional about that. Or, of course, we're here for you as well if you'd like to ask us specific questions after this broadcast is over. But in the meantime, we also need your feedback. We would love to hear how your impression was of this webinar and kind of your takeaway from the knowledge that it has given you. So with that in mind, we will be sending out a short survey to you via email, and we would be grateful to get your feedback on that as well. Now, accountants, we're not that dry. We have humor. We like to liven things up a little bit, so we give you a little funny here. Your accountant is saying to the client, you can't deduct Starbucks as a workspace. I mean, I know how much we all spend at that coffee giant, and it may seem like we live there, but it's not a workspace technically. And in the words of the Beach Boys, wouldn't it be nice? Now, we have free stuff that we want to give you. We have newsletters that are filled with educational tips. We have a Facebook page where we have lots of content that's both small and educational and fun and not overwhelming at all. But if you want to get acquainted, we also have on our website the ability for you to contact us and let us know what your interests are, and we can see if we are a good match for your situation. Now, we've also done some other tax reform webinars, and if you're interested in seeing any of those recordings, the first one was a tax reform for individuals and how that impacted the individual tax filer. Another one we did for the tax reform that relates specifically to businesses, which really ties into this webinar that Sabrina just delivered today. If you want to see any of those webinars, please email us at support@adminbooks.com, and we can send over the link so you don't miss out on anything. So a little bit about AdminBooks. We want to be a one-stop shop for you. We want to offer everything that you could possibly need. So not only do we do personal and business tax returns, we do tax projections, we do tax consultations, we do QuickBooks training, payroll, and monthly bookkeeping. So again, firm of the future, one-stop shop. Now, this is our contact information. We are available pretty much any way you want to reach us. If you're comfortable with the phone, there's our phone number. If you want to shoot us an email, if you want to go through our website and contact us through that way, Facebook as well, we are here for you. But in the meantime, I am going to get to the questions here. And so I see that we have some great questions that have come through. Again, keep in mind some of the more detailed questions I'm going to leave out of the mix temporarily. And also we need to keep our eye on the time. So with that being said, Sabrina, the first question that came through was, can you tell me if I'm understanding this correctly? I'm a consultant, joint filer, and my income is less than $315,000. Does that mean I get the full 20% deduction?
That means you get the full 20% deduction, yes. So if you're consulting, even though you're a service business, because you're under that $315,000 taxable income for a joint filer, you get 20% off the top. Easy, easy.
Winner, winner.
Winner, winner.
And then another question. I wanted to confirm, C Corps do not get the 20%, correct?
Correct, yes. Yep, pretty much everybody else but the C Corps.
Okay, next question. Is the 20% deduction based on my gross or net amount?
It's your net amount. So just remember net profit. So it's gross income minus your business expenses equals your net profit. It's 20% of that, potentially, subject to limitations.
Yeah. Okay, our next question is, how will I know if it's better to stay a sole proprietor or move to an S Corp? My colleague says S Corps are better and can save money.
Yeah, so this is a great question. And again, it's kind of what I talked about a little bit before when we were looking at those entity type slides, that it really depends. And I know that's not a good answer, but it really depends on your situation. Because like I said, you might look at it and say, well, I could get, more deduction going this way, but you have to also look at the other side of it. So when you're looking at Schedule C versus S Corp, are you going to save a lot of money from that self-employment tax issue? And so, you have to kind of weigh both of them. And there's no really set black and white answer. It's going to depend on your situation, your employee situation, your type of, what you're doing. There's so many factors to consider there. So it's hard to say. The colleague is not necessarily wrong, but it really depends. It definitely depends on your specific circumstances.
Okay, so here's a great question. Are contractors in the fields of electrical work, plumbing, HVAC, construction, and maintenance/repair considered to be in a specified service, trade, or business?
That is such a good question. And I think it's hard to answer it for sure. And ladies, feel free to chime in after I talk about this. But I think the difficult part right now is that all we're able to do right now is take the letter of the law and try to interpret it the way that we see. There's not a lot of guidance from IRS out there yet. And of course, we don't have court cases either to hang our hat on and sort of reference. With that being said, when I think about a contractor, for example, like a plumbing contractor, you think about what they're doing, that skill, that ability is really, it's the business, right? That ability to do that plumbing work. So when I think about that and I think about that reputation and skill factor, that would seem like a service business, a specified service business. On the other hand, when you're talking like a general contractor, maybe there's some room for interpretation there. Maybe we don't have to focus so much on that reputation skill item. I think it's really case by case and it depends. And you really have to look at the business as a whole and really, again, focus on that skill and reputation factor. How big is that to the business? And by the way, I do think, I just have to say this again, that is really the biggest gray area about that. And IRS is going to have to give us more guidance because there's just not enough right now. And ladies, I don't know if you want to chime in at all, but it's hard to say.
I'll just chime in and say that typically the IRS will give us more information towards the end of the year. So stay tuned, make sure you subscribe to our newsletter because that's where we're going to post a lot of the information, or our Facebook posts. So expect more information to come towards the end of the year.
Yeah, I agree.
Now, Sabrina, I think this question in particular is very interesting, considering that we also have the new layer of complexity with the Supreme Court decision regarding independent contractors.
Yes.
But the question is, should I change my contractors to employees in order to get a bigger deduction?
And again, great question. And I know I talked about this a little bit before. And as you mentioned, Misty, it's a really interesting time for this to come up because of that Supreme Court ruling that's really, again, tightening the rules regarding contractors. I think it's important to remember that, and it's like I said before, there's multiple things you want to consider. You want to also make sure that you can justify these people actually being called employees, right? Do you control their work, when they work, how they work? And that's important too. I think it more goes the other way when you're trying to justify having contractors, but you still want to pay attention to that. But it's very possible that it will make sense for you for both of those reasons. And like I showed in a couple of those scenarios where there were no W-2 wages paid, that really hurt for those people that were over those thresholds and had to look at that limitation. It really hurt. In one case, it was $2,500 versus $50,000 of deduction. So huge difference. So I think this is something you're definitely going to have to look at. And yes, it very well may make sense, but again, it's something you're going to want to look at your specific situation and, again, probably strategize with your tax professional and just see what makes sense. But I think we're going to see a lot of people doing that. I don't know about you ladies, but I think so.
I just want to pipe in here and comment that the rule that you're talking about, Sabrina, is the Supreme Court ruling specifically for the state of California. It's the state of California that is trying to generate revenue. And if there are any 1099 contractors deemed as contractors in California that are doing the core part of the business, they need to be deemed as employees. And so the US needs to be aware of this, because it doesn't apply to contractors outside of the state of California, but just inside the state of California. But the asterisk, the icing on the cupcake here is what you're saying is you may want to look at the contractors that you have in your business, and if you can get that higher deduction by paying them wages, which they're supposed to be paid based on those IRS rules that applies to every state, not just the state of California. But I just wanted to speak up on the ruling is for California.
Correct. Yes. Thank you. Thank you for clarifying that. Yeah.
Right. Okay. Our next question: is a rental property considered a qualified business property for purposes of the wage and property limitation?
It is, as long as, again, the activity is that property is part of is a trade or business activity that you're participating in. But yes, it does. And in fact, what I had read on this is that the initial draft of this 20%, the rules regarding this, they didn't even have a property piece. That was just a wage limitation. And I think that they added this to kind of appease people with rental properties and those kind of scenarios. So yes, it definitely qualifies as long as it is a trade or business activity.
Okay, so here's another question: if I am only part owner of a business, do I include all wages and property for the business for calculating the wage and property limitation in determining my deduction?
That's a good question. And the answer is you don't factor in all of it. You only factor in your percentage. So if you're a 60% owner of a business, you're going to look at 60% of the wages paid and 60% of the property amount, not the total. And that's a really good question.
Wow, that's very informative. Okay, the last question that we're going to get to today, since some of our other questions are a little more specific in nature. Last question here: why are architects and engineers excluded from the specified service, trade, or business classification?
Yeah, this is a good question. And actually, I didn't even really touch on this before, but it's true that actually those particular, so engineers and architects were actually struck from the letter of the law regarding specified service, trade, or business. And I think the best reason I can give, and feel free to chime in, ladies, is because those particular fields involve building something. You're building, basically, you're building towards something. Whereas the other, I think, and again, this goes back to the intent behind that rule. I think they're really trying to focus on service type of businesses. Again, if you're consulting, if you're doing accounting, if you're providing health consultation, that's definitely, straight service, it's kind of intellectual property, straight service businesses. Whereas I think with architects and engineers, they're kind of looking past that to, again, they're building buildings and they're, building things or creating things. And so it's a little bit different. And I think that's the best reason that I can give. I thought it was oddball that they were excluded specifically, but I think that that's the biggest reason why.
Okay, well, thank you so much, Sabrina. Like I mentioned, I know that we didn't touch on every single question that came in, mainly because they're a little more detailed and we're trying to keep this general in nature. If you want to shoot us your questions again via email or reach out to us on phone, we're more than happy to do our best to get back to you on that. Otherwise, if you want to reach out to your accountant, that's a great solution as well. But in the meantime, thank you so much for joining us, and we hope that we have given you a little bit of additional clarity on this new ruling. Take care, everyone. Bye-bye.
Thank you. Bye.